The stock market can be a scary place. If you want proof of that, look no further than the headlines on any given day. The stock market rally will run out of steam soon. The stock market is just taking a breather after January's monster rally. Wall Street's elite investors are privately warning that the stock market is headed for another scary plunge. This is not the end of the world. One of Wall Street's biggest bears says stocks will sputter this year but soar to record highs in 2024. And stock market improves, tries to bounce off daily lows, pizza stocks burn investors. So in a world where the stock market is so scary, how do you determine if you should be investing or not? Well, the answer is you should almost always be investing, buying stocks on a regular basis, but there are circumstances where you definitely should not. And that's what we're going to talk about in this video. But before we get into it, my name is Nolan Matthias, and if you want to thrive financially, this is the place for you. So go ahead, click that subscribe button and hit that like button so more people like you can see this video. Okay, so let's start off first and foremost with the fact that you should be investing in some way, shape, or form at pretty much all given times, except in some of the circumstances I'm going to talk about a little bit later on in this video. But it is clear that it's a very good idea as an individual who at some point may want to retire or may need a rainy day fund or who just wants to have some extra money put aside, that investing is a very good idea. And the simplest way that you can do that is to do what's called dollar cost averaging, which means that as you get paid, you take a portion of your income and you buy investments on the day that that income becomes available to you. And over the long term, your costs for your stocks and your investments will average out over time. You'll buy in the lows, you'll buy in the highs, but in the long run, you'll end up substantially better off. And if you don't know where to start, it's often as simple as researching balanced ETF portfolios, picking one and going from there. Some of the best examples of these are the Ray Dalio All-Weather Fund, the David Swensen Lazy Portfolio, or just a straight 60-40 split between stocks and bonds. Yes, that's 60% stocks and 40% bonds. And if you want a more risk-averse portfolio, you simply swap the two. And these portfolios are all made up of a series of ETFs, usually 4 to 5, that lower your overall risk versus the market. And the best of these over the last 15 to 20 years has seemed to be the Ray Dalio All-Season Portfolio, which in 2008 performed significantly better than both the S&P 500 and most of the other portfolios out there. Now, the key thing to remember here is that the only time that you realize losses in a portfolio like any of these that I just showed you is when you sell. So if you choose a more risky portfolio, then you want to make sure that when it does go down, you continue to buy and continue to dollar cost average over time. The worst thing you can do is look at your portfolio, see that you've lost half of your money, and then go and sell. Because what we know is that when you have a diversified portfolio, you're over the long term going to end up better off. Now, all that being said, it's obvious that you want to be a lifetime investor. However, there are some times where you definitely don't want to be buying stocks or ETFs or anything that is going to risk your money. So let's start first and foremost with the event where you may need the money soon. So this often happens with people who are looking to buy a house and are going to want to use their investments in order to make a down payment. This is a time where you almost certainly don't want to be investing in stocks because if there is a time where there is a drawdown or a major decline in the market, well, you could end up losing a significant amount of your down payment. So you definitely want to avoid investing in stocks and other investments, unless of course they're very, very secure investments if you're going to need the money very soon. Now, in addition to that, you also want to avoid buying stocks and investments if you can't handle the stress. Because like I said previously, you don't typically tend to realize losses unless you sell your stocks and your investments. So if you're the type of person who's going to see that the market had a bad day or maybe a bad month, and you're going to cash it all in and not realize the future gains on that money in order to get you back to even or back to where you want to be, then investing in stocks and other investments may not be right for you. Now, the third reason why you might not want to invest in stocks is if you are trying to time the market, because this is a fool's game. Yes, there are people who get lucky. Yes, there are people who win every single day trying to time the market. But for the majority of us, we aren't going to succeed if we try to buy low and sell high. That's why dollar cost averaging is so important and is the most reliable form of investing. Now, the fourth reason why you don't want to buy stocks is if you're going all in on one stock or one investment. And this includes everything, whether it's real estate or crypto. If you're going all in on one investment and putting all your eggs in one basket, well, there's a really good chance that you're risking everything. And if that investment doesn't perform, it could be financially devastating. So anytime that you think it's a good idea to put all your money in one basket, stop, take a break, and realize that the investment that you're probably making is probably too good to be true. Now, the fifth reason why you don't want to be investing in stocks is if you don't have a plan in place. So having a diversified portfolio like the all-weather one that we just talked about or any of the others gives you a plan. It gives you a framework to follow. But if you don't have that plan, you don't have that framework, and you aren't investing with intention, well, that can be a recipe for disaster, especially if you decide to change investing philosophies midway through. The sixth reason why you wouldn't want to buy stocks or investments is if you are borrowing money in order to make the investments. Now, margin and borrowing money are things that are very, very scary. And yes, there's a movement in Canada towards borrowing money off of your house and investing it. And that idea is just downright terrifying. Not only are you putting your investments at risk, but you're also putting your home at risk. Plus, what a lot of people don't realize is that when you borrow money to invest, you change the risk factor and the expected adjusted returns. So in other words, if you're expecting to get 10 or 12% return on your investments, but you've borrowed money to do it, the risk adjusted returns are significantly lower than that 8 or 10 or 12% that you're expecting. And if you risk adjust your returns, the real returns that end up happening after the fact are not the type of returns that you would want to leverage your house in order to make. Now, the seventh reason why you might not want to buy stocks or investments is if your portfolio isn't going to be diversified. Yes, we've talked a lot about this. You need to have a diversified portfolio. It is the single best way to protect yourself from major losses. And trust me, you don't want to be the person who at 40 or 50 or 60 years old loses a significant amount of their money because they put everything in an undiversified portfolio. It's just so easy to set up diversification right from the start that it makes zero sense not to do it. Now, the eighth reason why you wouldn't want to invest in stocks or other investments is if you don't have an emergency fund set up. Now, for me, I like my emergency fund to be 3 to 6 months worth of income. But if you don't have at least some money put aside for an emergency, you definitely shouldn't be investing. Because like I said earlier, if there's a chance you might need the money, you definitely don't want to be investing it. And not having an emergency fund is a prime example of the fact that you might need the money at some point in the near future. So set up your emergency fund first, then start investing. And if you don't have an emergency fund and you're borrowing money to invest, absolutely forget it. That is the dumbest idea ever. Now, the ninth reason why you might not want to invest in stocks or other investments is if you aren't taking advantage of all the tax-free opportunities to invest that are available to you. So these are things in the US like a Roth IRA or a 401k, and in Canada like a TFSA or an RSP. If you are not using these vehicles to invest, you definitely do not want to be investing in a normal stock market portfolio. The majority of the money that you spend in your life will go to the government via taxes. So if you are investing, you need to be making sure that you're taking advantage of the tax-free opportunities that you have. And we always recommend that you start with the tax-free options first, like the TFSA or the Roth IRA, where you are not taxed on the gains, and then move into the tax-deferred options like the 401k and the RRSP. So those are options where you'll be taxed in the future when you take the money out of those accounts, but not on the growth while the money is growing. Now, the 10th reason why you don't want to invest in stocks or bonds or anything else is if you have no idea what you're doing. I was told long ago by my mom, who taught me almost everything I know about investing, that it is your responsibility to take control of your money and understand what you are doing. And if you don't, let that be a signal to you that you need to learn. And here's the good news. It's not hard to learn about investing. In fact, there's a really great book called The Index Card that teaches you virtually everything you need to know about investing in a very small and very concise format. And best of all, you can get it on Audible and listen to it as well if reading isn't your thing. But knowing what to invest in, how to diversify your portfolio, and how to dollar cost average is so simple. It's so easy, and it gives you complete control. Now, on that note, the 11th reason why you shouldn't be investing is if you're giving control of your money to someone else. This is something that I just don't believe in. Now, it might be okay to give a portion of your money to somebody to invest, like a financial planner or something of that sort, but it is highly dangerous to give all your money to somebody to invest. Again, it's your responsibility to take control of your money and know what you're investing in. And if you're giving up control, that is often a recipe for disaster. Now, the 12th and last reason why you shouldn't be investing is if you're basically just gambling. We saw this quite a bit during 2020 and 2021 when Tesla stock was soaring, AMC was soaring, GameStop was soaring, and people were throwing all their money into investments and making a ton, and also losing a ton because they didn't know what they were doing. So if you're getting into the stock market and you're doing it just to make a quick buck, well, there's a good chance you're gambling, and there's a good chance you'll end up losing. So you need to have a strategy, you need to have diversification, and you need to be investing for the long term. And if you aren't doing all of those things, then you probably shouldn't be investing at all. But that doesn't mean that you shouldn't learn about investing and shouldn't start doing it soon, because ultimately 20, 30, 40 years down the road, how much money you have available to you is completely up to you. Oh, and last but not least, avoid the physical silver and gold game. It's a racket. You can check out this video on why right here.